My name is Larry Rosenthal, and I'm the Executive Director of the Berkeley Program on Housing and Urban Policy, and I want to make sure that you know how wonderful I think it is that you all took time out of your busy schedules to join us. We do a lot of this kind of thing on this campus, but we're not as often blessed to have a topic that everybody wants to know more about. And they want to know more about it because they're feeling a variety of pinches in their concerns about their own local economies at the household level. We're all quite hopeful that the blip that became a much larger Rorschach of all our concerns over the summer and has become really a financial crisis of historic proportions will be short-lived. And we're thinking very seriously about it. But we were blessed by your attentions and by the attentions of this wonderful panel of an agenda full of experts. And lastly, I just simply want to mention that this is the beginning of what we hope will be a continuing beautiful friendship between our program, the Berkeley Program on Housing and Urban Policy, our existing co-sponsors, but now this year for the first time in a formal way, the Ziman Center for Real Estate at UCLA. And with kind of two-campus leadership at the highest levels in the state, we're hoping to make more and more of the resources that our campuses and that all the other campuses in the UC system can bring to bear on these topics and future topics of concern. So please stay tuned to that developing story as well. A number of you folks who registered early know that we had scheduled in this lunch speaker slot the incoming President Pro Tem-elect of the California State Senate. He will be the new Don Parada, and already is the great Darrell Steinberg in his own right. We were informed earlier in the week that because of the special session on the budget that the governor wishes to call this week, that he had to stick around Sacramento, and we found ourselves in scrambling mode. Luckily, we found available a statewide leader in this field who happened to have time on his busy schedule to join us, and we're just delighted that he did. So let's move towards his remarks. Senator Michael Machado is the chair of the Banking, Finance, and Insurance Committee in the California State Senate. And he has worked both in the Assembly and the Senate in the last generation as a leader in the discussions relating to these markets. And particularly, since I first met him in December when we had a conversation in Los Angeles with a number of academics and industry representatives and finance folks on what the state should do about the gathering storm of the foreclosure crisis at that time. Senator Machado has been in the vanguard and leadership of those conversations, and almost all the legislative proposals that were brought to bear during the legislative consideration since have crossed his desk. He was educated at Stanford, which we admire and respect, and at UC Davis, which we admire and respect even more, and also at Harvard's London program. And we're just thrilled that he could join us to give us a few remarks on the current situation in Sacramento and his views, having weathered a series of storms in legislative terms over the last year or so. And then we'll be delighted to feature your questions for Senator Machado for a few minutes before we move on with the afternoon's panels. So without further ado, Senator Michael Machado.
Thank you, Larry. It's really is a pleasure to be here at this symposium. I think it takes good to note that you're dealing with the UC Berkeley and UCLA, two great public universities that are doing a great service to the public. Is that good enough, Stuart? I always try to joke with people that I become a card carrying for the library of both Stanford and the UC system, and that has been very helpful in my political career. I was really kind of fascinated at the discussion that we just concluded with Ben Bernanke and the panel, because if you're looking at the context of that discussion, I was thinking about the policy venue that we get into in Sacramento to make decisions. And we often have to sift it through and dumb it down to where we make a policy decision based on 2, 2, and 2. 2 for, 2 against, 2 minutes each. And if you think about that in terms of the complexity of the problem, that oftentimes is probably illustrative of the quality of the legislation. You know, my committee, the Senate Banking, Finance, Insurance Committee, held 5 informational hearings on mortgage lending and the foreclosure avoidance over the past 2 years. And many of you in the audience have been a part of those hearings, and I want to say from a personal perspective, the insights that I've gotten from you participating in those forums has been very helpful in us trying to synthesize what action we should be taking. I've been asked this afternoon to share a little perspective of the state legislature about the current mortgage situation and to talk about what we can and should be doing as we go forward. And I want to begin by offering a perspective for the last 14 years that I've been a state legislature, and I'll probably be taking a little more liberty than I might otherwise since I am termed out. And I'll also take time to talk about the perspective of some of my other colleagues. Often in Sacramento, discussions break down along party lines. The mortgage meltdown, though, was one of those rare policy issues in which the split wasn't among either Democrat or Republican lines. Instead, it seemed to have split itself across lines of economic philosophy and personal experiences. And much of the debate over the mortgage legislation had centered around 2 different philosophies. One was to work to address the deficiencies in current law that allowed abusive predatory behavior and to correct the problem going forward. And that's because much of the problem arose from a rapid infusion of new financial products that brokers and lenders didn't fully understand, and regulators were either unwilling or unable to keep up with. The other philosophy is what I call the mommy solution. Kiss the owie, put a lot of ointment on it, and the problem will go away. With the transition of mortgage lending away from neighborhood banks, corner savings and loans, non-depository institutions, and where both state and federal licensees offer mortgage products in California, my colleagues and I on the Senate Banking Committee firmly believe that California ought to set rules to all mortgage lenders, apply rules to all mortgage lenders and mortgage brokers operating in our state, regardless of whether these lenders are regulated by the federal government or by California. Because creating an unlevel playing field in which the states impose certain requirements on its licensees, but is preempted in imposing similar requirements on federal licensees, is dangerous. In the world of politics, the appearance of taking actions to solve problems is everything. Legislatures, let's face it, they feel good when they think they have taken action. But proposals to respond to the mortgage crisis with state-specific lending rules give a false sense of enhanced consumer protection, because consumer can still obtain loans from federally regulated lenders that aren't covered by state-specific rules. And in the short term, an unlevel playing field increases the cost of doing business and increases the cost for borrowers who go to state licensees for their loans. In the long term, an unlevel playing field encourages regulatory arbitrage, the idea that business will structure themselves in a way that allows them to operate in the least burdensome regulations, allowing in some instances the continuation of unscrupulous behavior. When states create unlevel playing fields, we find that many state licensees migrate to federal charters in order to escape the costly, burdensome state rules or the cost of dealing in both sectors. And the state rules, though well-intended, more often than not seek to eliminate consumer choice, limit the availability of capital, and promote litigation. Very stringent state-specific legislation impacts the willingness of secondary market participants to fund loans in these situations. And that's usually because of the stigma that becomes associated. And I think we only have to look to New York as an example of that. New York introduced the subprime lending law, and shortly after that went into effect, both Freddie Mac and Fannie Mae said they would not purchase New York subprime loans. That essentially dried up the secondary market and funding for these types of products. I don't believe there's anyone in this room that think loans should be harder to get than they are now. The longer mortgage markets suffer from the liquidity squeeze, the longer it's going to take for California to grow its way out of its economic problems. I think we should be taking steps to encourage responsible lending based on prudent underwriting standards and not rein it in. The effect of state-specific legislation is further diminished by the declining numbers of state-regulated lenders that are left. And many of the lenders who originated problem loans have either gone bankrupt, like New Century. New Century was actually appeared for one of our committee hearings in 2007 and said that they were the dream maker. They made people able to buy homes. Within 60 days later, they were bankrupt from that statement. Others, like IndyMac, a year ago, sat in a discussion down in Los Angeles who were talking about how they were handling the crisis. Others have stopped making new loans, like Option One and AmeriQuest, or they've been bought out, like Countrywide and Washington Mutual. The impact of all of the regulatory and financial restructuring, I believe, is still working itself out. But I'll predict that if you ask the Department of Corporations next year who their 10 largest state-regulated lenders are, you're going to find a lot of names we've never heard before. And most of the large players are now federally regulated, a trend I think we're going to see happen more and more as consolidation continues. And what that means is that if we go forward with more stringent state-specific lending, we're only going to impact the little guys where very few of the problems originated or exist. In addition, in the course of the committee's hearings on the mortgage crisis, it became apparent that two keys to consumer protection are informed consumers and adequate enforcement of existing laws. And I recall we held a town hall meeting early in 2007. I actually participated in 5 of them, and 2 of them included the Secretary Treasurer Paulson as well as the governor. But the first one we had 35 people show up. The last one we had 400. The first of the 35 was a husband and wife who were upside down in their loans, and they came in and they brought their documents, and they were English as a second language, and they bought their home from a real estate broker who was English as a second language. And they looked at this home and they thought it was great. And they found out that the husband said, I don't think we can afford it. So the lady that was showing the house flipped her hat around and says, well, look, I can help you get a loan. He signed a document that said 2.5% for 30 years fixed rate. He thought he was going to get that loan. In the bottom of the paper, it said, this is a proposal. 6 weeks later, when he came back to close, he got all the loan documents, and he had a 2.5% loan for 6 months, adjusted to LIBOR after that. He and his wife went into the home, thinking that what they had thought and understood earlier, and they were there now, upside down, unable to go out. This was a person that was a laborer, and his wife worked as a checker in Safeway. In the last hearing, last town hall we had, it was a different mix of people. There were actually a lot of state workers, middle-income people, who had bought in homes in terms of trying to buy up, who now all of a sudden found that they were upside down. So the market has kind of crossed all social economic stratas. But I believe that the point is from this was that consumers absolutely have to understand their loans that are being marketed. And it's something that we have begun to do in California. Earlier this year, the Department of Real Estate revised all the mortgage loan disclosure forms, and that was in direct response to a bill that I introduced in 2007 that required the state to comply with and apply the federal non-traditional subprime guidance to state licensees. Because I think once we educate consumers about the choices they have, then I also think we must trust consumers to make up their own minds. Government should not outlaw certain types of products, nor should government exist to save people from themselves. Individuals must take responsibility, but along with that personal responsibility must come choice, and we have to ensure that lenders practice responsible lending practices. Legislatures likewise have a responsibility to prod our state regulators to do their job, challenging them, encouraging them, and sometimes, as I'm often reminded by my staff, yelling at them, to get them to take and use their position to provide the type of regulatory oversight for the public and the consumers. But legislatures often have the responsibility, and one that we have not practiced very well, is to make sure that regulators have adequate staff and the resources to go after the bad actors. But I think it's important to remember that many of the loans that were made in 2005 and 6 were made legally in accordance with laws in effect at the time. And some of my colleagues have scolded our regulators for failing to enforce the law and contributing to the problems we're now seeing, and I disagree. In most cases, state regulators were enforcing the laws in effect at the time. And 2 years ago, California laws allowed poor underwriting and inadequate consumer disclosures. And now, thanks to the issuance of the non-traditional subprime guidance at the federal level, enactment of SB 385 in 2007, at the state level, and recent changes to Regulation Z, I believe our lending laws are much stronger. And the poor underwriting and inadequate consumer disclosures that were legal 2 years ago are illegal today. For that reason, I think the key to consumer protection going forward is to enforce the laws effectively, not adding more laws on top of the changes. And I think that's a point I'd like to stress. We ought to enforce. And by enforcing the laws, we provide the protection. We don't need, and it will be harmful to add, I believe, more restrictive laws on the top of the changes that have taken place. Now, in the other side, not every one of my 119 legislative colleagues in Sacramento agree with those views. Many of my assembly colleagues believe that California needs to go beyond federal laws in the areas of mortgage lending and servicing. I think, as I say, they believe in the mommy theory. Kiss the owie, make a big scene about being concerned, apply a liberal amount of ointment, that is, propose a plethora of new laws, and eventually the pain will go away. My colleagues believe that many of the problematic loans of 2005 and 6, and even first part of 2007, were made by state licensees and it's because of that they believe it's imperative to establish very stringent rules restricting the types of lending that can be done in California, enhance protections to provide to borrowers whose loans are serviced by California licensees. They believe that mortgage brokers are responsible for a large part of the current mortgage problem. They see broker abuses at the root of the problem. And they believe that most mortgage brokers are out to take advantage of borrowers, and that mortgage brokers frequently ignore the fiduciary responsibility they owe to their borrower clients. To a large degree, they also fault our state regulators, the Department of Real Estate and Department of Corporations in particular, for failing to crack down on lenders and brokers they see at the root of the problem. And this is the reason cited for giving individuals the ability to sue mortgage licensees over violations of lending laws. Many of the bills that came before my committee authorized private rights of action and encouraged borrowers to sue mortgage brokers and lenders over abuses rather than pursue and address the problems through state regulators. As a small businessman, I disagree with the approach and believe our regulators bear the responsibility for enforcing the laws and not the courts. And the more our courts are involved, the more costly it is to do business, and costs that then get passed on to the consumer that they will, and then this would also impede the reestablishment of liquidity and confidence in the mortgage market. Some also believe that borrowers are unable to protect themselves, unable to read or ask questions, unable to comparison shop, and incapable of taking personal responsibility for understanding important financial transactions in which they engage. For this reason, they believe that these certain types of loans should be banned outright, depriving borrowers of choice because if used improperly, their choices could prove dangerous to them. And I'm also intrigued by the consumer advocates, many who have appeared before my committee, who champion these type of reforms. On one hand, they want further restrictions on the availability of the mortgages for their constituencies. But at the same time, they want greater availability of mortgages for their constituencies. A very interesting dichotomy. It is those fundamental disagreements that played themselves out during the course of the past year in Sacramento. And I believe it's also going to be the basis of the discussions that will take place again in another week or so as the governor calls a special session to address the budget. And the governor has already announced legislation to address the mortgage crisis, that the mortgage crisis be included in special session, and that many of the bills that he vetoed are those who incurred those vetoes are planning to reintroduce those. And despite the governor's message in the vetoes that said, I think we need to wait to see how the actions that have been taken are carried out and what impact they have. I think that if we continue to make more attempts at state-specific legislation, the type of which I've talked about, but this will be quite harmful to the housing recovery in California. And I'd also like to close with a comment about some recent federal legislation. Many of you are economists and understand only too well the risk of moral hazard. And most of us believe that I think the recent federal actions were necessary to try to stop the global financial meltdown. But there are some who believe it's necessary to punish the prudent to avoid wrecking the economy and shredding our social fabric. I believe, though, as policymakers, we have a responsibility to the public to minimize any risk of moral hazard going forward. You know, we have a nation full of hardworking people, people who have made prudent decisions and have saved, have bought their homes, and are paying their mortgages. And it's really a question, I think, if you're going to reward somebody who made a bad decision, what does that say to those who waited, who saved, who took on a second job in order to be able to make that down payment, and who have both in their household working to make the payments to keep that house? I believe we need to step back and let the effects of the recent federal actions become known. I believe we're in a period of realignment of the very fundamentals of our economy. And legislators should avoid attempting to rebuild the status quo when the foundation may not be there to support it. As an agriculturalist and a legislator, I have seen cyclical patterns of commodity markets, the inflation period of the 70s, the burst and realignment of the high-tech bubble. And I believe the California economy and our regional statewide housing markets, too, will recover. But our role as legislators should not impede the recovery. Rather, perhaps, a little more attention to the state budget might be time better spent. We have our challenges going forward. I do hope that those who succeed me, as I am termed out too, will take heart and realize that California is not an island, and to try to establish policy as an island, I think will be detrimental to the recovery that we're trying to go through. Is the recovery easy? No. Is there going to be pain to be felt? Yes. But in any situation where you have overinflated values, Those values have to come out of the system in order to be able to get back to a ground level to build. And I think it's very difficult to rely on a legislature to make policy that has a 2 and 2 and 2 decision process. 2 for, 2 against, 2 minutes each. Thank you very much.
We have a few minutes for questions for Senator Machado. Any questions for Senator Machado? Here's one.
For about 75 years, or almost 75 years, anyone who sold common stock to a consumer has been held to a suitability standard. That is to say, one is prescribed from selling securities that are not suitable to the economic circumstances of the recipient. And as a result of that, there's a pretty efficient plaintiff's bar that's developed. These cases are arbitrated, and people think twice. If we had a system whereby mortgage brokers were bonded, and we could adopt the same thing, would you see any reason to be for or against it?
Well, I think you might say that we've approached that by imposing the subprime and predatory guidance onto the system, where you have to now loans have to be marketed based on the ability to repay. Doing a suitability standard, I think, opens it up for litigation, and I think you would reform the behavior, but I think the accessibility would also be limited too. And so the challenge is to strike the balance.
Well, I think you made a pretty good case for just eliminating state charters altogether and moving to a single federal standard. Given that we do have this, double system, wouldn't it be possible for the state regulators to say, innovate, for example, on disclosure, which has been a huge problem? For example, when you get a credit card solicitation, you get a box which describes a rate. And that's something that was done by an act of Congress, and it seems like something that the legislature could take action on to improve disclosure for consumers in California.
We did do that with the enactment of SB 385, which I introduced early in 2007, when we were actually almost a year ahead of the statement of those provisions that would provide the disclosure. What we're really looking down to now, you're going to get a single page when you do a mortgage that's going to say, this is the mortgage, this is your income, this is your monthly payments, and this is what this is what you would expect to have at. If you can't meet that particular standard and show the ability to pay over the life of the loan, regardless of what the introductory period is, you wouldn't qualify for the loan.
Other questions? Thank you very much. Thank you.
For the first panel this afternoon, I have the distinct pleasure of introducing my colleague, Robert Edelstein, who will introduce the panel. Bob?
Thank you very much, John. It is a pleasure to be here today. Certainly after you've listened to the speakers today and yesterday, you certainly get the sense that the subprime crisis is complex and multifaceted and rife with moral hazard and adverse selection, and is not easily solved. Probably two notions that have come out of what I've heard so far, and also part of my priors, is that there probably is no silver bullet that's going to solve everything. We probably don't understand everything anyway. Okay? And the second thing, and has gotten more recent attention after people have decided to try to fix financial institutions and a whole set of other things, is that there's a strategy must involve getting to the micro level of mortgages and figuring out how mortgagors and mortgagees and mortgage contracts work and how you solve them in the future. Of course, there were some other comments made by Bob Schiller, which sort of suggested that the micro behavioral financial aspects are important. And so I went out and sought the best advice I could get. And Philip Chow of Miami that's a Chinese restaurant. Now, in the good old days, they used to have things in their fortune cookies that would say Confucius say, but this place is really up to date and gave me advice which is really apt for this era. And it says, and if you want to see it later, you can, always yield to temptation. It may not pass you again soon. And I think we've really followed that advice, even without getting that. So now that was one incident. That's the recent incident. But I had another incident, and this may not be replicatable either. I was at a shishi cocktail party in New York, Wall Street investment bankers, and an investment banker was talking to Satan. And Satan, well, maybe it was a relative also. And Satan says to him, you know, I could recapitalize your investment bank. I could make you the most successful investment banker in the world with great fame and not to be considered a rogue. And the investment banker turns to Satan and says, this sounds intriguing. What do I have to do for you? He says, well, you know, the usual. You have to give me a soul and that of your children and your children's children and your children's children's children in perpetuity. The investment banker, sage person, says, I have to think about this. What's the catch? So with that as a background, we have assembled a panel that I think you'll find very interesting and really will provide some insights and no relations to any of the things I've said before, hopefully. We have our first speaker will be Chris Mayer from Columbia University, who will present a paper on mortgage market meltdown and housing prices. And then we'll have Paul Willen from the Federal Reserve Bank of Boston, who's done some interesting micro work, and he talk about subprime mortgages, foreclosures, and urban neighborhoods. And then we have three distinguished scholars to act as discussants and tell us truth beyond the papers. Mark, in order that we're presenting, is Walt Torous from UCLA, Mark Garmaise from UCLA, and Alex Tchistyi from our own program. Thank you here at UC Berkeley. Thank you.
Thanks a lot, Bob. Let's pull this up. I wanted to first just give a hearty thanks to the organizers for putting this together. I remember when both Stuart and John were emailing me suggesting kind of putting together a paper at a conference. I was kind of thinking, ugh, got to write another paper. This is a real pain in the butt. And about 6 or 8 weeks ago, it became clear that this was actually a really good opportunity. It was exactly the right time to think about kind of the policy issues, and putting something down on paper was a pretty useful way of kind of organizing thoughts and putting together some policy ideas. So I've taken both of you guys to heart in kind of that is the goal of the conference. So what I'm going to do is really two things in this paper. The first is try and make kind of much of a summary point, but some put in a little bit of statistical evidence to just sort of make the point that I think you know, I guess Tony Downs in his comments earlier suggested, but we haven't heard much about interest rates, and in particular long-term interest rates and the role that those played. And then the second thing is I'm going to completely switch gears and put forward a specific policy proposal for dealing with where we are, which is often kind of jumping up with a little target on your chest with a bullseye saying, shoot at me, but I'm perfectly willing to do that. And that's with my colleague and friend Glenn Hubbard at Columbia. So I wanted to just kind of start off. I think it's sort of interesting to just kind of look at the headlines and sort of understand what's going on. So, you know, if we look at the headlines of the last several years, see things like main categories of subprime loans, people with poor credit histories, loans made on the basis of unverified assertions of income, making up 1/10 of outstanding mortgages. Banks are tightening conditions on mortgages as the number of non-performing loans rises, pricing out potential buyers. And then this last comment, which I thought was particularly apt, real house prices are 82% higher than they were in the last quarter of 1999 and has risen 7% relative to national income. These are sort of certainly tough headlines. If you go back, this is from an article on the United Kingdom mortgage market. This is from the Spanish mortgage market, and this is the Australian housing market. So when you look at what's going on, a global perspective, I think, is useful in realizing that many of the same kinds of things, including subprime, no documentation loans, were made in the United Kingdom by regulated banks. And it has been regulated banks that failed. In Spain, the same pattern. These were regulated banks, and to the extent that they failed, the same basic pattern emerged. And in Australia, the same thing. Now, as Chairman Bernanke commented in his remarks earlier today, there is a global context, and when we look at sort of very, very different housing finance systems, and Susan Wachter has done some really interesting work kind of looking at some of these, what's going on in different countries, there is a sense that we're not alone in what's happening. And I want to just show you a little bit of other data that kind of goes along with this idea that we're not alone. The first is just plotting U.S. real house prices against those in various European countries. So this is the UK, Spain, France, and Ireland. And the point of this chart really is to suggest that for the most part, the United States was not particularly unique. In fact, if anything, house price appreciation in the United States is a little bit sedate relative to that in many parts of the world. We could look at other parts of the world, for example, Australia, South Korea, and China, certainly not countries that we think about as having very similar financial systems to ours. And we see a similar pattern. In fact, in China, where you have government-run lending and banks, we saw a massive housing boom in China over this time period, interrupted only by SARS in parts of Southeast Asia, or in Asia, but we saw the same basic pattern. And interestingly, having spent a little bit of time in South America, other again than the enormous collapse of markets, and you might say this is probably the least relevant analogy, but again, there's been an enormous boom in house prices. These are measured in dollars in Argentina, Brazil, Colombia. Same basic pattern. This isn't, of course, new. Pictures related to this, Bob Schiller has in a paper that he has in the Brookings paper a year ago. So making this point isn't a particularly new point, although I have to say Bob and I have a very different interpretation of looking at precisely the same data. But I think it's useful to look at these data to kind of understand. We spent a lot of time talking about subprime and credit and all of the excesses, and there were many excesses and there were real problems. But understanding that what went on is part of a global problem with different institutions helps kind of in the context of trying to understand what could have really been done when we think about this. The exception, of course, are Germany and Japan. I don't want to kind of talk about precisely there except to say that there are very, very different macroeconomic conditions and housing market conditions, particularly on the German side, and the financial conditions and the economy in Japan that make those countries ones where the analogy of pushing on a string and thinking about interest rates is often the Japanese analogy. Real rates were very, very low in Japan, but of course, they didn't spur any kind of economic activity whatsoever. The other thing I would just point out as somebody who teaches real estate finance at a business school is that not only was this not particularly unique to housing, housing is actually sedate when you look at what happens to commercial real estate. So I had a RA put together plots of looking at commercial real estate returns. So these are nominal returns. I actually realized I should have made them real returns, not going to make too much of a difference. It's important to sort of realize the scale on these graphs. So over a 3 or 4 year period, returns to commercial real estate range from a low, if you want to call it that in Australia, of 75%, to a high of more than 300% in France. That's cumulative returns. Now, we all know what the stock market did over the same time period. Now, these are leverage returns, and of course, you're getting paid your dividends, whereas if you own a home, the dividend isn't included, so you can't exactly compare these things to housing. But suffice it to say that the typical annualized returns across the country in investing in commercial real estate were anywhere from 20 to 50%. Just strikingly high rates of return that we didn't see in stock markets nearly to this extent. So when I sort of look across the world, and when I look at what went on, I do think that an argument that just says this is kind of entirely driven by either institutions in a particular country or entirely driven by kind of a global real estate bubble, I think that those arguments miss a real piece of what happened. And to my mind, and to my co-author's mind, Glenn Hubbard, what we see going on has been an extraordinary decline in long-term real interest rates, and this is very different than issues about what the Federal Reserve is doing at a moment in time, because in terms of asset prices, and I made this comment a little earlier, if you look at correlations with asset prices, you really need to look at long-term, not short-term rates to make much headway, and you have to be a little bit sensible in thinking about some of the comments about regime shifts or other things that have gone on, looking at time periods where, in real estate, for example, land supply went from being unconstrained to being constrained, and of course looking at different markets along the way, because it's very different to think about a Spanish market where they saw new construction grow 80% over the boom, compared to the United Kingdom, where you saw new construction grow 15%. And when you sort of forecast where you think things are going and what the long-term trends are, one has to really be careful in looking at these countries, so it's not just looking at house price appreciation, and we'll see this in a second when I look at data across US cities. So this is just, looking at European countries. These are real mortgage rates, and you could sort of see that the decline in real mortgage rates took place at precisely the same time that we saw this general run-up in real asset prices. And I go through a little bit of a discussion of the Gordon growth model. It's a very simplified model. In no sense is it perfect, but the general intuition that as interest rates decline, price is the dividend or the rent divided by the rate. As rates decline, rates get closer to zero, asset prices grow exponentially. That's just, purely a straight observation off of any kind of general asset pricing model. And so observing that fact, along with declining real and nominal interest rates, provides, to my mind, a fairly compelling explanation for what happened in many parts of the world. Now, we can talk about why that is. Tony Downs talked about sort of the glut of liquidity. That's kind of beyond my pay grade at the moment for this conference, probably beyond my pay grade, period. There are other people here who can talk about that. But I do think that what's gone on here has really been a striking change. And to my mind, it would have been enormously surprising if we hadn't seen. The anomaly would have been if we hadn't seen real asset prices start to grow as real interest rates decline. That, to me, would have been the true anomaly. Now, of course, the difficulty comes, and this is where I think the idea that Bob Shiller's had and argued in many places certainly bears some, bears some appreciation, is one problem is those rates started going up, but of course, asset prices continued to rise. And to my mind, at least, when one wants to kind of think about what happened, there really are two periods. The first period is during the 2001 to 2005 period, when we saw this sort of, what I would call a regime shift in declining real rates, followed by real rates going up, but asset prices continuing to rise. And this wasn't a period where we saw economic growth accelerating or any other good fundamentals. So in various countries, through different mechanisms, we saw leverage going up, and particularly when you look at balance sheets on the household side, it was really 2005 to 2007. And I have a paper coming out with Karen Pence and Shane Sherland in the Journal of Economic Perspectives that looks at median loan-to-value ratios for subprime loans. That was really the time period where we started seeing the no money down loans. Before 2005, and it's really the second half of 05 and on, people were still putting down some capital, but between 05 and 07, the median subprime loan had a 0% down payment. Similarly, this was when we saw securitization, CDO squareds, and other things come about. And this is when the significant leveraging of the financial system occurred and the household sector, which allowed asset prices to continue to rise even as we saw interest rates going a different direction. And that was when, to my mind, we really hit, asset prices hit unsustainable levels. And from that point on, we've really been in a significant crisis. So our story is the decline in real interest rates, and at some point prices outstripping fundamentals, and there clearly became some kind of a component where leverage and irrationality and all these other things played a role in what went on. You know, I talked about different, the different patterns. I'll show you one other piece of evidence completely different than the global evidence, which is just some statistical analysis in the U.S. I've written at times about using a user cost model, which is just a just a very simple version of the Gordon growth model for housing. And I use this not because it's a very good forecasting model, but roughly in the sort of question is, an important question that people have to have is sort of, are we at the right level of prices? And in order to ask the question, what is the right price level, you have to have some model in mind to think about that. And I think, basic, standard asset pricing model is a pretty good model to use for that. What we've done here, and this is kind of in the paper, the details of this, is basically just run a very simple regression, which is across metropolitan areas, and I've run this both with the Case and Shiller index as well as the Ofeo index, and you see that for the most part the results are fairly similar. Regress log house price on log of the user cost, and the user cost is a very simple formulation. You can think about it as the after-tax real interest rate adjusted for long-term growth rates across cities in the United States. So in other words, we use the 1950 to 2000 measure of average real growth rates from the paper that I wrote with Todd Sinai and Joe Jerko, Superstar Cities. We use the long-term real growth rate of house prices across those different cities. And basically, the user cost is just R minus G, putting into account taxes and other kinds of things. And if you regress just log price index on log user cost and log rents, rents come from a company called Reese, which has quality controlled rent data back to 1980, the theoretical prediction, and we have to put in fixed effects, so understand this is subject to a scale. So the way to interpret this is basically how are house prices relative to their 20-year average. That's the kind, how expensive or how high is the user cost relative to the 20-year average of house prices. And what you can see is the theoretical prediction is -1 on the user cost and +1 on log rent. I run this with and without year effects. If you run it without your fixed effects, you see the user cost has a coefficient of -0.7 to -0.85. And given how crude we've measured expected appreciation, I view that as actually a pretty strong piece of evidence that after-tax interest rates actually matter. And the second is a coefficient on log rent. And the inclusion of year effects doesn't change so much the coefficient on user cost, but it has a lot of effect on the coefficient on log rent, which really suggests that there is some excess sensitivity of the price to rent ratio, so prices are excessively volatile relative to rents, but that effect is almost entirely driven by national factors rather than local factors, because when you include year effects, that excess volatility sort of disappears. I think this is, for a user cost model that you could write down and estimate on your computer in a pretty short period without dealing with all the kinds of econometric complications, I think this is, pretty compelling evidence that suggests the user cost over some long-run period does not a bad job of explaining basic movements in prices and the price-to-rent ratio across markets. It doesn't mean it's perfect. This isn't a forecasting model, but it is just kind of how well does a basic, garden variety asset pricing model fit the data. The other thing I'd sort of point out that's kind of relevant to this is if we look at this division of markets that I first commented about in Jackson Hole a year and a half ago, we look at where real house prices have come today. in most of what I sort of divide up as cyclical markets using the Case and Shiller index, you sort of see that house prices are basically relative to where they were in 1987, something around 20 to 30% real above where they were in 1987. Given that these are markets where for the last 50 years house prices have grown at 2 to 3% real above the rest of the country, house prices today are not far from where you would have expected them if you just had a 2 to 3% real growth rate with nothing else. If you throw in user costs and recognize that real rates today are still lower than the average over the sort of time period, it actually says house prices have overcorrected a little bit in some of these markets. Of course, there's a second group of markets where expected growth rates have been very low, cycles have been low. That's exactly what a user cost model would say. And in these markets, again, you didn't see much of a run-up, and you haven't seen much of a decline, except Detroit, which has just gotten hammered for the economy. And the third set of markets, call them recent boomers. These are the markets that when Bob Shiller and I sat on a panel, we never disagreed with in terms of what was happening in these places. We both agreed there was a bubble in these markets. We still agree there was a bubble in these markets. And lo and behold, real house prices in Las Vegas have fallen back very, very close to the level they were for the last, for the last 20 years, and in fact, the level they were for the 30 years before that. From 1970 to 2000, house prices in Las Vegas grew cumulatively by 10% real. And Las Vegas went from having 150,000 people to 1.5 million. So when I look at this correction, I think house prices have kind of corrected to the level relative to where they should be. And in fact, if you kind of believe that low, given that the 10-year Treasury is still very close to its all-time low over the last 30 years, you would actually kind of believe that house prices should be a little higher than trend given that. So, and I lay out a lot more detail on this. Let's fast forward to September 08, and I'm going to refer back to Chairman Bernanke's comments briefly. I didn't know what they were, but this is what I wrote before hearing Chairman Bernanke's comments. Government takes conservatorship of the GSEs. Mortgage rates go up. It's a stunning fact to have looked at if given why the government was supposed to do this. This is the conforming mortgage rate. This is the 10-year Treasury. And if you look from its peak, either looking in the middle of 2007, we saw the 10-year Treasury drop about 150 basis points and bounce around pretty close to 150 basis points down. And we saw conforming mortgage rates drop no more than about 50 basis points. So if you look at this in spread terms, the spread between the 10-year Treasury, and by the way, the long-term average of this is 160 basis points, last 20 some odd years. That spread has risen from 160 to almost 250. And in fact, the spread today is higher than when the government took over Fannie and Freddie. This was, by the way, the proximate cause of them taking over Fannie and Freddie, was pointing out that Fannie and Freddie couldn't get credit. They were also insolvent, but that's a minor, a minor problem in this. If you look at this, you sort of say, why are we allowing this to happen, and what's the implications? Well, if you just do a simple user cost model, you can also do a rent-to-income, imputed rent-to-income number. I report both of those because a lot of people just care about the cost of housing relative to incomes. And by the way, imputed rent is really just the after-tax mortgage rate. That's the cost of owning a home. It's the after-tax mortgage rate plus some adjustment for growth across markets. That's a very common rule of thumb measure. Many Wall Street analysts actually use the same measure we do, although without the theory. They just look at the cost of owning, which is just the interest rate times the house price. And the only adjustment we make is that we actually think you should pay a higher price to rent ratio in markets where house prices have gone up for the last, almost 60 years. That difference, that 90 to 100 basis point difference in spread, changes the imputed rent-to-rent ratio, or sort of the cost of owning a home, by something between 10 and 17% across markets. So in other words, as we've watched the mortgage market start to fall apart, what we've seen is that pushes down demand for houses for all buyers. That malfunctioning of the mortgage market will take house prices to where they should have corrected today, down another 10 to 15% from here, just because at the moment the mortgage market isn't functioning well. And that's a very significant problem. So what should they do? Glenn Hubbard and I have a proposal to fix this. This is not really rocket science. In fact, there's a part of it that's a little more controversial, but the part that my guess is somewhat less controversial is we really need to bring down spreads back to their 20-year average. The second part, which is one that I think we believe in, which is we really have to deal with negative equity in household balance sheets in some sensible way, and we need to get these loans out of servicers. We have a proposal similar to the old Homeowner Loan Corporation in which the government shares losses on negative equity in return for getting some upside of the future appreciation of housing. What does this cost? Well, it's hard to propose a proposal without putting a cost, so I'm going to give you a number for the cost. Our real estate center bought data for deeds records for the bulk of the country. And what we've done is actually run some simulations by looking at anybody who had a mortgage since 2000 and tried to come up with a specific proposal and a specific cost. So lower mortgage rates, of course, aren't costing the government anything in the sense that this is returning the mortgage market to where it was for a long time, and presumably the risk-adjusted spread on that compensates the government given how much house prices have come down. Of course, the bigger part is using the government balance sheet to offset the cost of this, but unlike many government mandates, they're putting on the balance sheet an asset, which is fully underwritten mortgages at realistic loan-to-value ratios. And so there's an asset offsetting the liability, so that's not such a big deal when you sort of think about the balance sheet of the country. The bigger thing, of course, is this Homeowners Loan Corp, or the HOLC provision. Our proposal, which would have the government share losses with servicers or lenders of up to $100,000 split 50-50, would cost about $121 billion, but taxpayers would receive future equity in houses that would help offset that benefit. Why do this? The first is just many proposals have very complicated provisions. And I do think we can wait around and try and develop fairly sophisticated ideas, and we will watch the housing market continue to spiral downward and take with it additional financial systems and other problems. The second is there is no private mortgage market. Many people say, well, why is the government getting involved? The government is already originating 9 and 10 mortgages, and it is already setting mortgage rates. It's just using a very poor rule to set them, which is something about what people are willing to bid for impaired securities by Fannie Mae and Freddie Mac. So we are all, as taxpayers, setting mortgage rates. The question is, should we set them sensibly, or we should allow an impaired market, which isn't pricing mortgages at all, to try and set mortgage rates? The third point is that without fixing the mortgage market, that 10 to 17% decline in house prices be pretty devastating. A 20% house price decline so far has led to $600 billion of write-downs for banks. And the question is, somewhere other in the financial system, no matter what we do with foreclosures, if house prices falling, there are going to be significant losses in the financial system. And by the way, as taxpayers, we're on the hook for $6 trillion of mortgage guarantees. That's half of the mortgages outstanding we've already guaranteed. We actually have an incentive to try and stop this from happening. The macroeconomic stimulus of this would provide a stimulus of $118 billion per year through lower mortgage loans. In our estimate, 20 million homeowners using microdata can refinance existing mortgages, saving an average of about $350 a month. That reduces aggregate mortgage payments by $39 billion a year. And the HOLC provision for write-downs reduces mortgage payments by another $16 billion. And of course, if you actually think people are liquidity constrained, you might care that they're paying lower mortgage amortization of about $42 billion. This is not a one-time stimulus. This is a permanent stimulus. If there's anything left in the permanent income model in the world, the life cycle model, we should believe that permanent things have more of an effect than transitory ones. The additional wealth effect, I don't know what you want to use for marginal propensity to consume. I'll use a number lower than Case Shiller and Quigley use. I'll use 3.5%. Given that change, that's roughly a $63 billion marginal propensity to consume from reducing housing drops. Lots of other benefits. We're helping make housing affordable for new home buyers, which helps stabilize the price and eat up the 3 million vacant homes at the moment. It's a strong step to provide consumer confidence. We remove millions of mortgages from troubled and conflicted servicers. One of the sort of stunning things to me is I think many people continue to put proposals forth about working with servicers. To my view, what we should be doing is getting as many of these loans out of servicers as possible, because the only thing we know is the servicers are inherently conflicted and will never make a good decision. And we should try and get the loans out of servicers and stabilize as many of them as possible, as opposed to continuing to try and force them to do things that aren't in their economic interest nor anything that they would exert effort to. And finally, most importantly, I think this benefits the bulk of homeowners. Many of these political proposals, as one sees on the front page of the New York Times today, really have this critique that they substantially benefit the people who took on the most debt and provide no benefit to the bulk of Americans in the housing market. Lowering mortgage rates is a pure middle-class program and helps many, many, many people in the country. And it would seem to me, from a political perspective, again, above my pay grade, has benefits. So at the end of the day, what we're trying to do is make an intellectual argument that interest rates matter, argue that malfunctioning credit markets are a problem, and to argue that the government can do things to help fix this, that don't require massive interventions in lots of other areas, but do involve, I think, kind of some sensible policy of understanding the problems with consumers and how to fix them.
Thank you.
I'd like to thank the organizers for inviting me. These two, Chris and my paper, are both on the same, the title of this section is the same, but they could not be more different. I am going to talk today, that's big picture, this is small picture. So you may think this is sort of the details, and Chris is the, you're not going to get any big policy recommendations from this. Okay, so this is, actually it's joint work with Chris Girardi of the Atlanta Fed. Let me just start by saying that I'm speaking today as a researcher and as a concerned citizen, and not as a representative of either the Boston Fed or of the Federal Reserve System. And when I say we, I don't mean Ben and me. So let me just say one thing just before I start. Today is Halloween, and my children are actually very grateful that I was invited to this conference, because my son wanted to be something really scary for Halloween. And so I put together a costume for both of my sons to be something really scary, which was subprime mortgages. And so my older son, I made him a costume as First Lien 228 from New Century, and my younger son is a piggyback. But anyway, they're relieved that I'm here, so they can go as ghosts or whatever it was they really think are scary. Anyway, okay, so I'm going to talk about three things today. I'm going to talk about the foreclosures and the subprime crisis and the location in Massachusetts, which is really a crisis, an urban crisis, and I'll show you maps in just a second. I'm going to talk about the role of subprime in home ownership, and finally I'm going to talk about some policy options, including to some extent some of the things that Chris mentioned early on in the context of these urban neighborhoods. So the data that we're going to use, Chris mentioned deed registry data. We're using the deed registry data from Massachusetts. We focus on Massachusetts partly because that's where we are, but really because we have exceptionally good data, and we've worked with the data. We've done an extraordinary amount of work with the data, so we know this data very well, and we can say, I think, we can be fairly confident of what we're saying. We have data for each property. We have every purchase and sale agreement. We have every mortgage and every foreclosure deed going from 1989 to the present. That allows us to follow home ownership experiences. So each property, in other words, the unique property ID, we can follow. We can see how much the borrower paid. We can see how much they borrowed, who they borrowed the money from, and we can follow that property over time. But what's different about this paper from some other papers which we've written using the same data is that this time we actually matched each of these properties, or to the extent that we could, match these properties to HMDA information, And specifically for the purposes of this paper, that allowed us to identify the race of the homeowner. So we can track a homeowner from purchase and sale to foreclosure or sale, or if they still have the house, and we know for that whole homeownership experience what the race of the homeowner is. Okay, so one of the facts, one of the nice things, well, it's not a nice thing, but for a researcher, I guess it is that in Massachusetts, we've had actually 2 waves of foreclosures, or at least in our data. One in the early 1990s, and then the second one in 2007. And what's significant about this picture is really the differences. So the darker areas are higher minority concentration. And what you can see that has changed between 1992 and 2007 is that basically all of the foreclosures now, in Boston at least, are in minority areas. So this over here, for those of you who know Boston, that area over there up on the top left where there are a ton of foreclosures, that's Commonwealth Avenue along the Brookline border, and there was a lot of condominium development over there, condo conversions, which accounted for a lot of the foreclosures last time around. This time, the foreclosures are almost all in these sort of blighted urban neighborhoods, and that's true across the whole state. So what we're going to focus on in our empirical analysis actually is these multifamily properties. So those of you who, again, I know there are a lot of people here who Berkeley went to MIT, so you know a little about New England. The triple decker is a typical property. It's a 3-family property, and they're very common in Massachusetts. They account for about 10% of the housing stock, and they're really concentrated. I mean, basically, you can tell where the urban areas are on this map because that's where these small multifamily properties are. And the reason we focus on them is, as I say, they're all in urban neighborhoods, and they account for a hugely disproportionate number of the foreclosures. So what we're looking at here is the housing units foreclosed upon. So that means for each multifamily, we're counting each of the subunits of that property. In other words, this gives you some sense of how many households were affected by foreclosure rather than homeowners. And one of the reasons why multifamily, we focus on it a lot in Massachusetts is sort of a built-in externality here. There's always this debate about what the externalities are of foreclosures. With these multifamily units, the tenants are almost always evicted. And so in this case, it's very easy to see what the externality is. It's all the tenants who obviously bear no responsibility at all for the decision of the homeowner, but who ended up losing their home. Anyway, that's all units, and this is the portion accounted for by multifamily. And you can see that more than half of the units affected by foreclosure in Massachusetts are multifamily. About 10% of the properties in Massachusetts are multifamily, so this is hugely disproportionate effect. And you can see this in the prices. This is an index we constructed, a Case-Shiller type price index that we constructed. This is for all units in Massachusetts, and then this is for multifamily. And you can see that basically multifamily are much more volatile than the single family or than the population as a whole. It went down almost 40% in the early 1990s. They've already come down quite a bit now, and the data we're using goes through the end of 2007. We actually looked at the data for the first quarter of 2008, and it's dramatically worse. So this continues to get worse. So what did we do? What we wanted to understand really was to understand what was going on in this crisis. And this is related to another paper that some people here have seen, since I presented it here about 6 months ago. We looked at the relationship between house prices and foreclosures. And basically, I just want to make this point again and again. The big driver of foreclosures in Massachusetts is house prices. You can see it back there. You can see it in the early 1990s. You can see it here. So we estimated a model which allowed us to do the following counterfactual exercise. So this is actual, these are people who bought homes in 2005. These are actual foreclosures for those people. This is the percentage of people who bought multifamily properties in 2005, and this is the percentage of them that have lost those homes to foreclosure. So it's up to around 9% of the people. And these are actual foreclosures. This isn't the beginning of the process. These are people whose homes actually changed hands. So this is the actual number. We estimated a model. The predicted foreclosures in the model does a pretty good job. It's roughly what we, it's roughly accurate, so in sample. But then we did two experiments. One of them was to ask the question, just to illustrate how important the prices are, is to is to look at the predicted foreclosures if all we changed, we took the same buyers from 2005, but we gave them the 2002 house price appreciation series. And this is what you get. So we would have had less than about 1% of these properties would have ended up in foreclosure as opposed to 9. But the other thing that we did was to go back to 1990, and I think this is what's important about this crisis, to go back to 1990 and to ask the question, all right, so let's look at what happened in 1990. This is actual foreclosures for 1990. You can see it's much lower. This is for people who bought in 1990, so this isn't 2007, this would be 1992 here. This is the percentage of them that 2 years after having bought the house, the percentage of them that were in foreclosure, and it was about 4%. But then what we did was we asked, well, what would have happened to the 2005 buyers if they had gotten the 1990 house price appreciation? And actually, for multifamily, the 1990, at this point in the cycle, the price appreciation was much worse. If we had the 1990 prices with the 2005 buyers, our predicted foreclosures would be up to 18%. So what is the difference between the 1990 buyers and the 2005 buyers? The difference is subprime. And we've estimated this, when you go back into the data, subprime, people who buy home mortgages with subprime mortgages, and I'm very careful, we're collecting all kinds of things, all the reasons why you might have used a subprime mortgage. So it could be because your credit score was low, or it could be because you were trying to buy a house that you wouldn't have been able to afford without a subprime mortgage. That cocktail of things, the hazard for foreclosure for people who bought with subprime as opposed to people who didn't is something like 10 times higher. And that accounts for this gap between the 1990 actual and what we predict for 2005 buyers with 1990 prices. Okay, so that's the role of subprime. So subprime basically created, in our mind, a group of very unstable homeowners in the inner city. And that's led to an enormous number of foreclosures. I said the house prices have not fallen enough yet, anywhere close to what they actually fell in the last cycle, and yet we have this huge foreclosure crisis. So the question is, though, is who the argument always made for why subprime was a good thing for the inner city was that it led to expanded homeownership. And so you run the risk when you expand homeownership of creating this group of people who are more vulnerable. But the question we wanted to know was what was the upside of subprime? What were the gains? What were the good things about subprime? And the main thing that people point to is the fact that home ownership increased. And so this is for African American borrowers in Massachusetts. They went from about 2.5% of the buyers up through 2003. The fraction of buyers accounted for by African Americans basically doubled. So that was for African Americans, and for Hispanic borrowers, you saw a similar phenomenon. And what was the role of subprime? Well, in an accounting sense, the role of subprime was huge. Basically, if we look at what happened to prime only, and this is for African Americans, if people who bought homes with prime only, their share of total purchases in Massachusetts stayed about the same. And the same is true for Hispanics. So all of the increase in home ownership, in home purchases, by African Americans and by Hispanic borrowers is accounted for by subprime. So this looks like a good thing, but you have to be very careful. So this is it's one of these kind of tricky things in any sort of statistical analysis, which is separating out gross and net flows. So the issue here is that what we're looking at is gross flows. We're looking at purchases. But what we're really interested in is net flows. So if we're interested in increasing home ownership, what we're interested in is the net flow, which is the gross flow. It's initiations of new home ownerships, minus the gross flow out of home ownership, which is terminations. And the initiations here are purchases, and the termination of home ownerships are sales and foreclosures. So if there really was a big increase in home ownership, I mean, the assumption when you looked at that picture before, the reason why you thought that would have led to higher home ownership is because you're assuming that the gross flow out of home ownership, the terminations, are remaining stable. And that basically we have a lot of new people moving into, so new African American homeowners, and they're not offset by terminations among other African American homeowners. And so this is for for our data set where we actually could match the purchases with the, well, this is a fully matched sample. This is the share of initiations accounted for by African Americans. And this, you can see, this is the share of homeowning households in 2000, share of blacks who owned households, who owned homes in Massachusetts in 2000 was well below this. So they're buying more than their share. So we would expect home ownership to be going up. And furthermore, by the end here, it's above their share of the total households in the population. So they were actually, by the end of this, blacks were disproportionately represented in the purchase data. So this would suggest that there's a big increase in home ownership. But that's before we put in the terminations. When you put in the terminations, you see that the terminations rose at about exactly the same rate as the initiations. And so that means that, in fact, the net flow into home ownership was basically constant through this period. It was positive, but constant. And actually, the most distressing thing is that the terminations went from sales to foreclosures. So this, the percentage of people who are actually moving out voluntarily has gone down. And we actually have a matched sample where we can see the rate of the purchaser and the seller. And what you see through this period is exactly what this data would suggest. Basically, what happened was not that African Americans were buying homes from white homeowners. In this period, African Americans, the share of African Americans who were buying homes from other African Americans is what went up. So we didn't see any increase in home ownership because for every African American who moved into home ownership, another one moved out. Okay, and the picture for Hispanics is a little better. This is it's similar in the sense that their share went up. It was above their share of total households. But the share of terminations, you can see here, the net, I mean, there was an increase in net flows into home ownership, but it was nowhere near as big as the increase in gross flows. Okay, so the last thing I'm going to talk about here is policy implications. So what can we do? A lot of people have talked today about concessions to borrowers. I was actually quite impressed by Paul Jablonski's discussion yesterday of what went on in Congress, because some of the things he said were things I had never heard anyone say before about the Hope for Homeowners program. So the problem here, the idea here is that we give concessions to borrowers. We reduce the principal balance on the mortgage. And the basic logic here is that for a lender, this is good business if the reduced principal balance exceeds the loss from foreclosure. And that seems like, how could anybody not do this? And so there have been a lot of explanations given that it's some bureaucratic problem or it has to do with the servicer-lender agreements. However, I mean, it would be an error not to take, if it's true that the reduced principal balance, if you're a lender, and the reduction in the principal balance you have to give is going to exceed the loss from foreclosure, assuming that the borrower doesn't redefault, and we'll get to that in just a second, it would be an error not to take advantage of this. So it would be a mistake if you didn't do this. You have an obligation to your investors to do this. So why is it that no one ever reduces principal? And so according to a banker, now this is a banker, not a servicer, this is a banker talking about his own portfolio, he says, we have not to date forgiven any principal. This is a guy who's got lots of defaults, but he has not forgiven any principals. What's his reason? He says, we are wary of the consequences of being known as a bank that forgives principal. So what is the problem here? Well, I'm calling it type 1 and type 2 error. There are two mistakes you can make when dealing with a borrower in foreclosure. One of them is type 1 error, which is not assisting a borrower who can't repay. And this is what most of these proposals have focused on, is basically saying, I have a borrower here, he can't repay. If I cut his principal, he can repay it and I'll recover my money. That's type 1 error. But then there's type 2 error, which is providing costly assistance to a borrower who will repay. And most of the proposals have focused on type 1 error and have paid only kind of lip service to measuring this type 2 error. So we're going to do a little back-of-the-envelope calculation here about measuring type 1 and type 2 error in foreclosure proposals. Okay, so we start, this is for our data, this is for a single-family home with prime mortgage in Massachusetts. We looked at borrowers with negative 20% equity, and we calculated the probability of foreclosure. It's around 4%. In other words, that's this is a home ownership probability, so it's not quite on the mortgage. This is the probability they'll ever default on that mortgage. If we raise their equity to 10%, the probability of foreclosure falls to 2%. Okay, so what are the errors here? The type 1 error here is basically 0. It's actually a little more than 0. The benefits here of principal reduction are small because you have so few borrowers who are going to go into default. So the possibility of type 1 error is fairly small because you have so few borrowers who are going to end up in foreclosure. The type 2 error, though, is huge. And this gets at this issue that when you offer assistance to borrowers who are in trouble, you're essentially offering assistance to everyone. Because we know borrowers can do a good job faking being qualified for a mortgage. It's very, very easy to fake not being qualified for a mortgage, which is what people have to do. And you laugh. But I mean, if you want to show your income is high, that's hard. But if I want to show my income is low, I just tell my wife to quit her job. I start, I finish papers really late, and anyway, do all kinds of things like that. I make fun of the chairman. Okay, so I can do it. Anyway, if we look at multifamily in Massachusetts, the prime ones, the probability of foreclosure is still high. It's much higher. And the benefits, therefore, of the type 1 error is much bigger. But the type 2 error is still huge because remember, you're bailing out 83%. 83% of your borrowers are going to repay their mortgages. And if you're assisting 83% of the borrowers, you're going to spend a lot of money for people who don't actually need the assistance. For subprime, it gets better because the probability of foreclosure goes up to 1/3, but then you're still helping out 67%. It's with the multifamily that this might actually make sense because according to our estimates, 2/3 of these people are going to lose their home to foreclosure. In that case, the probability of foreclosure goes from 63 to 13. So the type 1 error is huge, and the type 2 error is relatively small because only 37% of the people would have not foreclosed anyway. Okay, so let me just go. Is type 2 error overstated? I've already said this. This is actually a quote from the Times today, from the article someone mentioned, but it was in the Times today. Is type 2 error overstated? Basically, you've got to prove that you can't afford your house, and we'll redo your mortgage. So people are skilled at proving that they can afford, and now they're going to have to get skilled at proving that they can't. Is type 1 error overstated? Probably also overstated, because we're assuming that all of the borrowers here will qualify for this principal reduction. But in fact, the conditions for qualifying for this principal reduction are basically that you have to be able to get another, so for example, for Hope for Homeowners, you have to be able to qualify for an FHA mortgage. And a lot of these people here are not going to qualify for an FHA mortgage under any conditions, and certainly not even with a 30% reduction in the balance on that house. Okay, so that's all I have to say today. Thanks for listening. Everybody always asks for the slides. Nobody ever gets to read the papers. So anyway, if you want a copy of the slides, feel free to email me.
Thank you.
As Paul mentioned, these two papers couldn't be more different, but they do share sort of a common attribute, and that's the fact that they're excellent sort of well thought out research papers, and the author should be commended. Now, what we the three discussants decided, given the nature of these papers, that what we would do, we would slice and dice sort of a securitization on there to the discussion. So we'll take out little pieces that we found interesting and sort of talk about each of them. So I'm going to begin our set of discussions, and I'll talk about the paper that Chris Mayer presented. And I think this is a particularly interesting paper for a number of reasons. And the aspect of the paper that I want to comment on is sort of the dynamics of house prices. Because as we know from yesterday's discussion and in general, that this mortgage meltdown has as its basis the fact that house prices gyrated so much in the earlier part of this decade and then fell so precipitously. So it's very, very important to understand house price dynamics. Okay? And if I'm not so good with these, okay. All right, so I'm going to pose a question here. And the question is following. If the 10-year real Treasury yield fell by 200 basis points, what would we expect would happen to house prices? Now, you heard Chris's presentation, so you know his answer. And I'm going to be a little more agnostic. And I'm going to say, sort of an academic answer, well, it depends. And in fact, I'll go so far as to say, well, maybe nothing. And I'll try and back this up. And again, we've talked about this model today a number of times. I'm going to look at the so-called static Gordon model, also known as the user cost model. And this is really a workhorse of valuation. It's used quite a bit valuing financial assets in general. We're going to use it to value house prices. And so capital P is the price of the house. Capital R is the foregone rental that you would have to pay otherwise. R we'll think of as a real rate, and G is the growth rate. And all I'm going to do is, the next equation is simply rewrite that in terms of the real rate. And basically, the question I pose is, well, what's going to happen if little r falls? Right? And the answer is, well, you know, Chris's scenario is correct, right? It could very well be that the price level rises, so the rent-to-price ratio falls. Or alternatively, it could very well be that G falls, or you could have a little bit of both. But in the latter case, so particularly if G does the brunt of the work, then that's sort of my conceivable scenario in which the rent-price ratio might very well not be affected by declines in real yields. So at the end of the day, this all boils down to an empirical issue. And you really need to sort of cast this in sort of a more appropriate model, in my opinion. And you need a model in which, you know, house prices can change for reasons other than changing real yields. It could very well be changes in risk premia. It could be changes in rents, et cetera. And the framework that a lot of people have begun to look at to analyze this sort of question is sort of the dynamic version as opposed to the static version of this Gordon model. And that was the model, the Campbell-Schiller dynamic Gordon model. Okay? And so what I'm going to do is just sort of cite a few papers that have looked at this issue and have tried to ask and answer the question, you know, is it changing real rates that sort of drove the dynamics of house prices? And again, I admit I didn't do an exhaustive sort of survey, and I'm sure there are other papers out there, but the sense I get is that, you know, perhaps not, that real rates may not sort of be what's driving this. And again, that's also to say that, you know, perhaps we really don't know what's going on, and I think it's really an interesting area to do a little more research and try to really understand what's going on. So I cite two papers. So the first paper is by Marcus Brunemeyer and Juilliard, which came out recently in the Review of Financial Studies, and it's entitled Money Illusion and Housing Frenzies. And again, they use the sort of this dynamic Gordon model, and they document that the real interest rate, again, sort of the real 10-year rate. They also looked at tip rates at all. They did a very careful job. And they also did an international study. So they didn't only look at US data, they looked at UK data, et cetera. And they found that, you know, the real interest rate had very little, if any, explanatory power for the housing rent-to-price ratio. And they put forward this money illusion argument. And the idea was that, you know, homeowners are confused between changes in nominal rates and changes in real rates. And because of that, that confusion sort of boosts house prices when you're in a period of sort of declining inflation, because they tend to systematically underestimate sort of the real cost of future mortgage payments. So what Brunemeyer and his co-author did is they resurrected the old paper by Modigliani and Cohn back in the late 70s, who tried to explain why you might see very low stock prices in a world of high inflation or rising inflation. And this is sort of the obverse of it. Sort of if you're in a period of low inflation, falling inflation rates, people are going to be subjected to this money illusion, and that leads to this sort of frenzy, this bubble in housing prices. So that's one paper there. Another paper by, again, this is Sean Campbell, not John Campbell, a number of, I think, economists who are or were at the Federal Reserve. It's entitled What Moves Housing Markets. And they conclude, again, using this sort of Campbell-Schiller framework, that very little, if any, of the variation in the housing's rent-to-price ratio can be explained by variation in real rates. And again, they say, well, what's going on is that the risk premium is moving. And they contend that any of the real interest rate effect, that's sort of offset by this negative covariance between real rates and the risk premium. So think of this is sort of like a flight to quality story that's been recently sort of characterizing financial markets, where you've had real rates falling and yet at the same time sort of stock prices falling, reflecting sort of a rising risk premium. Okay, so I guess I'm sure that Chris's idea, there's probably a lot of juice in real rates in terms of affecting house prices, but I don't think it's the complete story. I think there's a lot more work to be done, and I think going back to Bob Schiller's point this morning, you can see that a lot of this data, maybe the Brunemeyer study goes back to 1966, but you look at the second study, goes back to 1997. We're looking at 10-year episodes, 20-year episodes. It would be great to sort of perhaps go back as far as we can to try and come up with a more definitive answer. So I would say sort of what is the effect of real interest rates on house prices? I think it's unclear at this particular point, at least in my mind. Okay. Now, for something completely different, let me comment on Paul's paper, Subprime Mortgages, Foreclosures in Urban Neighborhoods. Okay? And, as you could tell from Paul's discussion, they did really a superb job really documenting the impact of purchase subprime loans on what he and his co-authors have referred to as this home ownership experience of minority and low-income households. Okay, so I've sort of italicized that these are purchase subprime loans. These are loans that you take out to purchase a home. And I want to comment on the fact that there is another, if you will, path by which homeowners can transition into the subprime loan, and that's cash-out refinancing. And I want to argue that this alternative path may be very important in the context of affordable housing. And the reason is sort of some of the facts that are documented in Paul's paper. Home equity, which cash-out refinancing means, right? That's whereby you're going to refinance and sort of extract some of the equity out of your property. Well, this may be very important for African-American Hispanic households, because if you read Paul's paper, which I didn't look at the slides, 61% of their net worth is made up of home equity as compared to 44% for white households. So home equity is a far more important source of wealth for these disadvantaged homeowners. And furthermore, I would argue that the likelihood of their being subjected to adverse economic shocks is very high, right? They have low levels of schooling. They basically have low levels of medical insurance coverage, et cetera, et cetera. So it makes sense that if an adverse economic shock hits this household, they need to find some source of equity, some money. They're going to attempt to do a cash-out refinancing, and it turns out that the problem confronting, it turns out, many borrowers in the last few years was, well, we're hit with this adverse economic shock. We want to extract the maximum amount of equity, but then we're subject to a very binding income constraint. How do we do that to sort of minimize monthly payments, at least in the short run, because we believe that at some point we'll be able to dig ourselves out of this hole? Well, they go into the subprime market, and the subprime market that they go into is, to keep those monthly payments very low, the adjustable rate subprime mortgage, right? So the product choice there is not simply, going subprime versus prime, but it's sort of fixed rate subprime versus adjustable rate. And the constraints following these households is really such that many of them gravitated towards subprime adjustable rate mortgages. Now, this whole transition has really been documented by a number of papers written by two researchers at the University of North Carolina, Spader and Quircera. And they basically have been looking at this CAP program in Durham, North Carolina, which was a partnership between Fannie Mae, the Ford Foundation, and Self-Help. And when you read these papers, and sort of the message you get for affordable housing is the fact that, there's the challenge sort of confronting, this affordable housing is sort of not only to sort of design a financial arrangement, if you will, that will allow individuals to buy homes, but I think the whole idea is to make sure that this financial arrangement is quite robust to subsequent economic shocks. Because, what good is it to sort of get people into a home and then sort of any sort of hiccup in their sort of livelihood causes them to end up sort of, into a subprime product, which then leads them to be more likely to end up in default or foreclosure, okay? So I think sort of people interested in affordable housing have to sort of think this through, that, the design of the mortgage should basically sort of be robust across the whole lifetime experience of these homeowners. But in general, sort of my final concluding point I want to make here is that, in general, I think, as house prices sort of appreciated dramatically during this particular decade, a contributing factor to the subsequent meltdown was really the preponderance of this cash-out refinancing. I mean, there was a huge amount of equity being taken out of appreciated housing. And I would argue that doing so caused a lot of issues because, first of all, it offset the deleveraging effects of rising house prices. And furthermore, to the extent that, as house prices rose and everyone refinanced at the same point in time, you ended up synchronizing a lot of homeowners' default decisions that wouldn't have been synchronized otherwise. And I think that had, dire consequences because once house prices fell, you had this whole clustering of defaults. And then when you have these structured finance products like collateralized debt obligations, you're just going to see, the whole, all these particular sort of tranches and layers just fall en masse as a result. And that's very important because, this whole problem has been exacerbated by the fact that, there's no more interest in these structured financial products. And we've got to sort of make sure, as Chairman Bernanke mentioned, that we need to get securitization, back working to sort of, get that spigot of capital flowing. So anyway, I did write a paper on this, and anytime you mention your own paper means that it's time for you to get off the stage. So I'm going to pass it on to my colleague, Mark Garmaise.
Okay, thank you. These were two provocative and innovative papers. It's a pleasure to discuss them. I'm going to start with Chris's paper. As I read the paper, the main finding is that the user cost model actually does a pretty good job in helping us understand prices of real estate, and in particular that I found more convincing than Walt, this idea that real interest rates really are a main driver of pricing in global markets. And the authors have two main policy recommendations. The first is that current mortgage spreads are at a disequilibrium rate, that the spreads are too high. Government needs to come in and reduce those. And secondly, we have a lot of negative equity homeowners who need to be refinanced, and those losses should be split between the government and the lender. So let me talk a little bit about these policy recommendations. It's very important, especially for the second, this idea of restructuring, that we believe that house prices have now returned to an appropriate level. We wouldn't want to start engaging in restructuring now just to face another, say, 25% decline in prices and then have to redo the problem all over. And indeed, the authors do suggest that they have some evidence that house prices have hit the right levels. under the historic mortgage spread. So if you use the usual mortgage spread, 160 basis points over treasuries, you put that into the user cost model, seems like house prices are back where they should be. But to me, the question is the historic spread still the appropriate one? Maybe the historic spread was based on investors' experiences of housing returns nationally. Maybe nobody imagined that we could have negative national housing returns. We've now found out, in fact, yes, you can, that our awareness of the possibility of these kinds of rare events has appropriately increased the spread on mortgage rates, and maybe actually the market is pricing them correctly. I'm going to go a little bit further and say it's also possible that the risk of equity investments in housing has also increased. Okay, so we've experienced a kind of housing meltdown that maybe people didn't think was very likely. We now understand it's certainly a possibility. Risk premia have to rise. When risk premia rise, prices need to decline, and in fact, just using the author's own analytical framework, I might conclude that significant future house price declines are warranted and that we could expect them. If that's true, then now is certainly not the time to engage in artificially propping up a market that's just too high. More broadly, anytime we propose significant government interventions in the market, I think it's important to know what externalities the government is fixing, and the authors do suggest a couple. The first is restructurings are just going so slowly. Right, this inefficiency that actually Paul also talked about. You have people with negative equity, foreclosures are very inefficient. Why do we see so many liquidations and so few renegotiations between borrowers and lenders? And I'm not sure actually that they are going so slowly, so it's hard to tell. But one alliance of lenders called Hope Now says that in just September of 2008, they initiated 210,000 mortgage workouts. Yes, they also had 180,000 foreclosure starts, but that to me suggests that at least the private sector is taking seriously the possibility that restructurings are important. Not clear we need a massive government intervention. The second externality that they describe is the negative neighborhood effects, and I think that's very, very plausible. You don't want vacant houses that could attract crime, et cetera, but maybe we should just attack that problem directly, perhaps by fining owners of vacant homes. Not clear we need the subsidy that's being described. Moreover, the subsidy is really quite big. So $120 billion, I guess, in the context of recent discussions, doesn't seem like a lot of money, but it still seems like a lot of money to me. What do we get for our $120 billion? And the authors talk about a projected, say, 10 to 17% increase in home values. And I wasn't quite sure about that, just in the sense that the authors are arguing that we've got a disequilibrium in the mortgage markets now, but their pricing model sticks in the discount rate forever. So in other words, the 10 to 17% increase only comes if the market thinks that the current disequilibrium price is going to persist in perpetuity. If the market just thinks, well, we're going to have a couple of years of really high mortgage spreads and then return to normal levels, then correcting that temporary disequilibrium should increase prices a little bit, but certainly not 10 to 17%. For me, the bottom line is this is a very large direct subsidy to both lenders and borrowers who simply took inappropriate risks. I agree, and it seems like everyone here today does, that a macro stimulus might be appropriate. Why not make it income-based rather than housing-based, right? Why not target it, for example, at the unemployed, whose ranks might be growing, or the very poor, who are never able to buy houses at all? Okay, so a couple of comments on Paul's paper. So as I read this paper, subprime boom led to certainly more purchases, but also more ownership terminations by minority buyers, and increasing equity, a very natural finding, but a good one to see. Increasing equity does significantly decrease the foreclosure hazard. So what's the main policy recommendation from this paper? Well, if you look at one particular class of borrowers, the multifamily subprime borrowers, they have a very high probability of default. If banks are worried about people falsely claiming to be on the verge of default, well, here's a class of borrowers that banks can help without any of that risk. And the net recommendation is multifamily subprime borrowers should get principal reductions from banks. And I think this is a very interesting idea, and indeed, the authors do show that reducing negative equity can significantly reduce foreclosure hazards. The question that I had was, are the foreclosure hazards so high for this particular class of borrowers that there's little that we can do to help them? And actually, the table that Paul put up showing that increases in equity really do make a big difference is very nice. I may have missed it in the draft that I saw. I think that's actually a very helpful table to show. Still, I was left wondering just how sensitive this class of borrowers is to overall housing price levels. And if housing price levels drop by another 10%, are these borrowers just going to end up defaulting? And in particular, I was led to this question by the finding in the paper that there was an increase in buying, there was an increase in selling. I was wondering if a lot of these multifamily subprime borrowers were flipping, essentially, counting on house price increases. And if we don't have those, that they're just inevitably going to end up in default. If that's the case, then the main impact of principal reductions would just be to postpone the inevitable, and that's actually quite a bad thing because my guess is that maintenance is going to be neglected in the interim. You're essentially going to have owners not taking care of their homes, and that doesn't seem like a benefit. I do agree with Paul and his co-author that there are negative externalities, in particular for evicted tenants, but again, maybe we need a direct policy approach there, maybe a moratorium for a couple of months or for a year on tenants who have been kept current on their rents. That seems like a more direct approach to that problem. Okay, so overall, I guess I'm going to say that at least I would continue to lean in favor of just the traditional remedies here: orderly liquidations by banks, sales of foreclosed properties, turn them into rentals as quickly as possible, maintain protections along the lines that I described earlier, along with a more generalized macro stimulus. That's all I got.
Alexei.
Okay, thank you for having me here. I really enjoyed reading both papers. I think they address very relevant questions to today's economy, and the results and policy implications are very thought-provoking. So I start with Chris's paper. The key question of this paper, I believe, is to determine what is the appropriate value of the house, or otherwise, where home prices should be under normal circumstances. And one way to do it is to compare the rent and cost of home ownership. This involves two key parameters: mortgage rates and home price appreciation. And the primary focus of the analysis of the paper is on mortgage rates. The paper finds the following. The real interest rates do pretty good job explaining initial home price appreciation during the housing boom. And I find this result plausible despite the evidence that in the past interest rates did a poor job explaining home prices. And the reason is that today's home market is quite different from the past. First of all, because of the subprime lending. Subprime borrowers are probably much more sensitive to interest rates than other categories. Also, we had financial innovations and quite fast home appreciation rates. In addition, we also had a lot of financial innovations in the housing market. Okay, but after interest rates went down, home prices continued to rise, and they overshoot the fundamental level. That's what the paper finds. Now, home prices are back to the fundamental level, but interest rates, not the interest rates, but mortgage rates are high, approximately 1% above normal level. And what is normal level is a historical level in Chris's paper. What it means is that if mortgage rates stay at this level, then home prices will continue to fall by additional 10 to 17%. And this finding produces the following proposal. We need to reduce mortgage rates back to normal level or historical level, and also reduce balances for distressed homeowners. The question that I have is, what is normal here? And as Mark pointed out, well, future home prices are actually the expectations about future home prices may determine what is normal now, okay? For example, if we expect further home prices decline, home prices will decline even further, then it will mean that interest rates should be high today. But I would argue that multiple equilibria are possible in this situation. The first equilibrium is what Mark proposed, and I think it's a pretty reasonable description of what is going on in the economy right now. Everybody expects that home prices will continue to fall. What it means is that defaults in the future are going to be more likely and more costly, which means that lending today is more risky. This generates higher mortgage rates, higher mortgage spreads today. So those high mortgage spreads that we observe today, they are normal given the expectations that we have about future home prices. But if mortgage rates are high, the demand for housing is low because few people can qualify for mortgages, few people can afford houses. So the home prices will continue to fall. So this is like a self-fulfilling expectations. What I argue is that this type of behavior of home prices may actually generate another real estate cycle. Because once the home prices go under the equilibrium level, then after they reach the bottom, they will start appreciation towards the fundamental level, and they may again overshoot the fundamental level. So this is the situation that I believe we are right now. But we can imagine a different equilibrium, and I guess that's what the paper is about. So normal equilibrium. In this equilibrium, we expect that home prices stabilize at the current level, okay? And the current level is the fundamental level. This means that defaults are less likely and less costly in the future. Lending is less risky now, which means that mortgage rates should be lower. The spread should go back towards historical levels, okay? This means that the demand for housing will be higher, and this will support the home prices at the current level. And so how I view the policy recommendations? I think they will work, okay? Because the main objective of the government intervention is to switch from equilibrium number 1, in which we are now, to equilibrium number 2, which is the good equilibrium. That's where we want to be, normal equilibrium. So how to do it? Well, stimulate the demand by reducing foreclosures and reducing interest rates, reducing mortgage balances. And the cost of government intervention will crucially depend on whether we are targeting the right price level, okay? If we start support a price level above the equilibrium level, the fundamental level or normal level, this will, of course, provide wrong incentives for home buyers, home owners, home builders, and lenders. But also, it will be costly for the government to sustain this price level. And more importantly, it wouldn't change the expectations. Because this price level is not sustainable, lenders will still believe that the home prices eventually will go down, and they will keep charging higher rates on the mortgages. That's why I believe the paper is very important. And what is very important is to determine this right fundamental level. What I would like to know more is how to handle the expectations in this model. So far, the analysis mostly assumes makes little or no explanation about expected future home prices. I think we need to know more how to include it in the model. Okay, so now about the Paul's paper. The key finding is very surprising, at least to me, because contrary to the popular belief, and I was the one who actually believed it, subprime lending did not lead to an increase in home ownership by minorities. Okay? Instead, it simply generated excess turnover in properties owned by minorities. And rising in foreclosures has largely canceled out the earlier gains in home ownership. So quite a surprising finding. And it's easy to jump to a conclusion that it's another evidence that subprime lending is equivalent to predatory lending. I know Paul is not making this argument, but if you read the paper, you may think about it, given especially the very bad reputation of subprime lenders. And actually, the evidence fits the following story pretty well. We have naive borrowers which are targeted by predatory lenders who are making money on each loan. And the more loans they underwrite, the more money they are making. They encourage borrowers to take those loans and sell their properties excessively. Okay? So if this is true, what is the policy implication? Well, no more credit for risky borrowers. Unfortunately, I don't think this is a good policy recommendation at this point because so many borrowers are risky now, and we actually need to support them somehow. So I'm not trying to deny that there are no evidence of predatory lending, but I would like to point out that actually the key failure happened not in minority neighborhoods, but on the Wall Street. And this is because the Wall Street funded those extremely risky loans. They bet on house appreciation, maybe, but at the end of the day, they either simply ignored or greatly mispriced risks of subprime lending. And they are more sophisticated investors. So you cannot blame subprime broker for underwriting those bad loans because brokers knew that they could sell those loans to those more sophisticated investors. And those more sophisticated investors simply were telling them, look, those loans are good since we are buying them, okay? Anyway, so I guess the one policy recommendation would be is to fix Wall Street standards, lending standards on Wall Street first. And then Wall Street will actually, at least partially, take care about subprime market. Because if Wall Street find that subprime lending is inappropriate, involves a lot of risk, they probably wouldn't fund this activity. Okay, so and the paper touches a little bit costs and benefits analysis of subprime lending. So, and the findings are not very good in terms of benefits, but I would like to give some arguments that it may not be that bad. For example, this high buy and selling activity looks like not making much sense because it doesn't increase home ownership, but this high buy and selling activity may be actually justified by applying simple microeconomic analysis. What happened was that, first of all, subprime lending relaxed credit constraints, and then home prices changed a lot, and the home price appreciation was, and then depreciation was especially dramatic in those neighborhoods. What it means that, given this relaxed credit constraints and different home prices, people simply adjusted their consumption of housing and other goods, given new realities. And this, of course, would involve excessive trade and turnover of housing. So that's one point. The other point is that Massachusetts is probably not a representative state because it's an expensive state. And one thing that the analysis of welfare analysis should take care of is the possible migration from in or out of state. My conjecture is that probably because home prices, real estate property was very expensive at some point, at least in Massachusetts, some homeowners simply sold their houses and moved to cheaper states. So essentially, they benefited to some degree from this housing market, but the analysis doesn't take it into account. Thank you.
Thank you. What I'd like to do is first let the original authors have a comeback if there's anything they wish to say.
First, I appreciate the comments very much from the discussants. I just wanted to make a couple of comments. The first is I find it enormously implausible that changes in G can explain the sort of pattern across different markets, across different countries at the same time. And I do find it sort of odd that as economists, we might resist the idea that we're going to have these highly synchronized offsetting changes in G and R that just happen to explain the same pattern across lots of places with very different economies that all explain the same fact. Let me talk about the two papers specifically very briefly. Brunermeyer's paper on inflation illusion is an interesting paper. I think it says very little about what's going on in the current boom because it is very hard pressed to explain why it is in different parts of the country that had the same inflation level and the same expectations of inflation to have enormously different experiences in house price changes. So that really needs a model that says something about local conditions, and the user cost model with different expected growth rates does a much better job. I think changes in inflation, that's the only paper I've ever seen and the only person I've ever seen who thinks that inflation illusion had much at all to do with the current changes in house prices, either in the US or across the world. The way to think about that model is an aggregate time series of one country at a time. It is not looking across countries. And so their evidence about inflation is completely conditional on the model they've written down. And I discussed that paper at the NBER, and I can send you lots of problems with what's going on with that. The Campbell et al. paper has a very simple observation, which is it's a little hard to explain user costs when you have 0 cycles. So they're looking at cross-sectional changes across markets with no cycles in them. So it's a little hard to kind of think about what's going on. It's actually the persistent cyclical pattern of prices in some places and the non-cyclical pattern in others, which is what the user cost model relatively powerfully explains. I think the second point, which was across all of the discussants, is changes in the risk premium, and I think that's exactly the right question we should be asking at the moment. I will comment that the standard models people use that don't recognize housing miss the consumption value of housing. This is a point Sinai and Solelis have made repeatedly, and I think you can't just sort of write down a standard model that doesn't recognize the consumption benefits of housing and the hedging nature thereof, and housing that doesn't take that into account. So the standard sort of time-varying risk models that we have don't do the trick. If you're going to just steal a finance model and kind of throw it down. But I take the issue of have risk premiums changed because we've really seen an out of sample jump. That's your sort of point, Mark. I think that's a very serious question one wants to think about. I would suggest that when we look at different parts of the country, if we take, for example, markets where house prices in real terms are basically back to the level they were in 2000. That's the sort of Vegas's, Miami's, where we think that real house prices are determined by real construction costs. In that world, actually, if risk premium change, it's not prices but rents that adjust, because prices are tied down by the cost of building a home. And so the rent to price level adjusts through changes in rents, not changes in prices. So one also has to kind of think hard in these different markets about what that underlying growth rate of rents are. But I would also say that if you just sort of did a very simple thing and you kind of looked at what that, you know, Walt's sort of concern is how do you estimate that? Alexei's the same thing. Well, take a number from 1950 to 2000. Before the recent boom, whether there's a regime shift or anything else, I think that's not a bad estimate. And again, house prices fall today, sit right along that 55-year trend in the data. Again, reason to sort of think that we've kind of adjusted to reasonable levels. And final thing, I think, Alexei, the point about multiple equilibria is really important because there is a sense that the government does, in fact, control almost the entire housing market, housing origination market, as well as have half of the losses on its balance sheet. And if there are multiple equilibria in the world where setting expectations determines whether house prices fall a lot or whether they fall a little, that is exactly the point at which a social planner would worry about multiple equilibria and would in fact work to encourage confidence and bring credit back into the market because the owner of those liabilities as well as the assets is the same party.
Paul? Well, thank you guys for excellent comments. So on the refinance issue, so every paper we've written, we started off with some prior about what we were going to write, and it has almost invariably turned out the opposite was true. But fortunately, the topic was interesting, and people don't seem to mind. So on this topic, on the topic of the refinances, the way you would see this in looking at the transitions and looking at the gross flows, and I think one of our priors was that the ability of borrowers in the inner city to refinance, allowed by subprime, would make it less likely for them to transition out of home ownership. In other words, they had an option. So before it was easy to refinance, before it was easy to take cash out, their only alternative in if they had a bad income shock or health shock or something, was a temporary shock, was to sell the property. But now they have this option of doing a cash out refinance. So we thought that would make a difference. It's a little hard to tell here. One of the things that's also important about the subprime market is that it was a refinance market first. It didn't really emerge as a purchase market until much later, basically when you see the big increase in subprime purchase mortgages. So you would think you would have seen some impact on transitions on the hazard rate, on the sale hazard, basically, before that, which it's hard to tell from this data whether it's there because it really doesn't capture the whole period. But anyway, it's an important topic, and we actually have spent a lot of time trying to figure out how to measure the cash out in our data. It's hard. And among other things, there were all kinds of closing costs, which could be quite considerable, and there's no way of knowing, at least from our data, how big those were. In fact, there's no way of knowing from any data how big those were. So if anybody knows. No?
FHA closing costs?
Oh, yes. FHA, oh, right, sorry. Sorry. Yes?
Loans.
What? All right, anyway, we can talk about this later. I'm sorry, I should have said that there is one exception to the claim. It's been where I'm always asking.
It costs about $50 a loan since I've been here.
It's a lot, yeah. But these days, just not $100 million. On Mark, I actually totally agree with you. I'm not actually saying, I think you're probably right, that for a lot of these homeowners in the inner city with the multifamilies, it probably would make sense. There have been all kinds of discussions about things like, for example, allowing community groups to come in and buy them. But in this case, it's basically encouraging the lenders to do short sales, which is another thing that they're surprising, that they're very, very reluctant to do, as I understand it, because of the concerns about fraud as well. But to encourage them to do short sales of these properties, this is a situation where they would still be better off. Yes.
Elaborate that for a second. The concerns about fraud.
There's fraud in every aspect of mortgages, and I was puzzled. I was like, what would short sale fraud? But they all knew. And short sale fraud is that the buyer of the property is in fact the seller. So you basically come around and you say, listen, I found a buyer who wants to buy my property for 30% less than the value of the mortgage, and I'll sell it, and then you'll be off the hook. And it turns out that that person is in fact you. Or you sell it. Exactly right. And then the other thing I guess you do is you agree on a price that's way below the market value, and then you split the difference with the buyer. What's sad about
personal experience.
Not personal experience. What is sad about the mortgage market is if the ingenuity with which people pursued fraud, they had pursued legitimate tactics. It's hard. Exactly. Exactly. You know, I often think about extensions on quizzes. It's a lot of the same issues, or extensions on and stuff like that with undergraduates. They're very similar. Okay, so I totally agree with you, Mark, on that. I'm not saying that. I think we should be open to all kinds of options, and I think increasingly people are. I mean, one piece of good news from the REO data is that you can look at the same flows, net versus gross flows in REO, and for a long time, the flows out of REO in Massachusetts were much smaller than the flows into REO, and that has changed in the last few months. So there's been a big increase in the flows out of REO. So it seems like lenders are much more willing, or servicers are becoming much more willing to sell the properties than they were before. So the net additions to REO in the last few months have been very small, in spite of the fact that the gross additions have been enormous. And so the last thing, Alexei, you were correctly careful to say that I wasn't saying that subprime, and in fact, whatever my personal opinions are, we're just trying to report the facts here, hard as that may be to believe, in this situation. So I'm not saying this buying and selling was excessive. I have no idea. And you're absolutely right. There are certainly anybody who sold in 2003 or 2004, or in especially in 2005, which is when I bought my house. Anybody who sold, basically there was a big net transfer from investors to the seller of the property. That is in the case where the borrower eventually defaulted, or to the taxpayer, I guess.
I'd like to open the floor to questions. Let's start over here, the gentleman.
Since we're voting in 4 days, can you explain how your proposal relates to McCain's proposal? Is there any?
There is no relationship, and we have actually asked the McCain administration at one time at the beginning when they put this out, they referred to the opinion piece we wrote in the Wall Street Journal. We have asked them not to refer to that because it isn't what we've put forth.
What is the difference?
Right. I mean, I could go the different, and it's just completely unrelated. McCain wants to spend $300 billion buying distressed mortgages at some price we have no idea, at par or something else, and through some unspecified way work out some of those mortgages. So there is no relationship between what he's proposed and what Glenn and I have at all.
The ability to live in New York City will exonerate you.
I have a comment about the
and my guess is the two authors are voting differently.
Hi, I'm Ed Lemer again. I have a comment about the use of the word home price, as if we had 100,000 homes out there for sale, identical, and 1,000 were actually sold, and you actually knew what the price was at each unit. But in reality, there's a tremendous amount of home-specific risk. So if you do this Case-Shiller type of analysis in which you do the matched pairs of homes and explain the appreciation rate, and ask, in the LA area, this is where I've done it, and ask how much residual there is, it's 30%, meaning that there's 30% unexplained. Let me complete. It's not all, 30% is not explained by the holding period. So things change within the house to some extent. But I think it alerts you to the fact that your ability to shop and to bargain has a big impact on the price of your specific unit. They're just not all identical units. So when you're talking about a short sale is really tough because the lender doesn't know what that price really is. And in terms of that 30% band, where do I lie within that? And if you're trying to help out homeowners, you can't tell whether a homeowner is underwater with regard to the value of their home until you get an offer on a darn thing. So it's extremely difficult to do it.
Is there any comment up here first? Response?
No.
Okay, Bob?
Well, I've learned a lot at this conference on this default resolution question, which I think a lot of us believe is pretty central. One is that the workout approach is really impractical. There's a big mechanism design literature on this type of problem, and the answer seems to be hopeless. And that's because of the extreme moral hazard that Paul talked about. So that makes me think that some kind of resolution to the short sale problem is much more promising. The big problem there seems to be speed. We talked about how Wells Fargo handles short sales, but it takes, and even them presumably working their best, since they don't hold the mortgages themselves, their communication channel takes 6 months apparently to get an answer to a. Oh, sorry. Whatever.
Some financial.
All right. So we need So how about this? Give every homeowner a put right to a local organization that would run an auction the very next week. So we have weekly auctions, and you can put your house in the auction, and then that's the amount of money that the lender gets. That would solve the biggest problem, which seems to be the speed. And the problem is these houses deteriorate very rapidly. If no time at all goes by between the time the homeowner elects the put and the price is determined, then you get rid of a large amount of the house deterioration problem. Then of course the question is just how you enforce this on the owner of the mortgage. But I guess of course the homeowner can bid. It's a fair auction, absolutely. Absolutely, sure. But yeah, it has to get an FHA mortgage too. Now, let me make another comment that I think has not been adequately realized, and that is the federal government has the power to override contracts. This was the Windstar issue that the Supreme Court decided in the 1990s. A very wise decision, and I think that the federal government has been very reluctant to follow the lesson of Windstar. But the lesson of Windstar is that you can override private contracts, but if you do so, you have to obey the Pareto principle. You have to compensate the losers. But if the efficiency gains, if the externalities are anything like what we believe they are, the federal government should run rampant over private contracts. It should not obey any private contract, but it should get every loser, every financial institution that's a loser, should be able to file a Windstar case, which eventually will be decided in a fair way in federal court. And I dismiss all this ridiculous concept that there's something wrong with our litigation system. Litigation system works extremely well, and the federal courts give very good answers. And they did in Windstar, and I participated in some of the Windstar cases, and I can say up close that that process worked. And the federal government should not be shy about overriding private contracts.
Let's just over here first.
Yeah.
John?
One quick thing, which is I wrote my dissertation looking at the real estate auctions in the 1980s and early 1990s. They were very successful at generating liquidity. They had prices that looked a lot more like the Case-Shiller prices, which really are more like liquidation prices because they're what happens when REO goes to lenders and immediately comes back on the market with lenders realizing we don't want to hold this for very long. So I think there is a process to do that. Technically, foreclosures, by the way, do that. Anybody can show up and bid at the foreclosure. Practically, they don't. But I do think we're starting to see that. The question is, in that world, what you're really advocating is basically doing a sort of well-informed foreclosure auction. It still doesn't reduce the number of foreclosures or people kicked out of their houses at all in that world. And there are arguments in favor of that, but that would have the effect of allowing a very large number of foreclosures to take place, which is what people are trying to avoid. I'm not saying it's the wrong policy, but it doesn't reduce foreclosures.
What I learned at this conference is that we want to speed up the foreclosure process and make it work rather than discourage it.
That's the Japan versus the RTC argument, which has a lot of merit to it.
But I mean, there's no reason why the federal government has to respect these contracts. They'd have to give fair compensation. That's the constitutional requirement. The rest of it is, when did FDR went off the gold standard like that? There was a zillion contracts on gold, and the next day they didn't exist. So that's not the problem, right?
There wasn't compensation then. That was unconstitutional.
But if that's the floor, Robert.
But John, the question is, when you talk about sort of going off of contracts, it's not sort of clear what. You can do it once. No, but what's the goal of it? Because the goal of Bob's sort of comment is to have foreclosures happen as soon as possible. Virtually all of the reduced foreclosure arguments are exactly the opposite, which is to stop foreclosures. So the issue, even if you grant the sort of question of what to do if we're not going to allow contracts, essentially mandating foreclosures seems to me to be an incredibly difficult policy conclusion. And there is some kind of, I do think that fundamentally, we can talk all we want about contracts. We need to get these loans out of the servicers, because no matter what mechanism you have for doing that, the servicers are inherently conflicted. They will never make good decisions about how to handle this, period. They're not paid enough, and their incentives are terrible. And so what the issue of contracts, I think, gets around this issue of, if we're going to get these out of servicers, which is the economic inefficiency here, how do we go about doing that best?
We have a question in the back. Yep.
Most everything I heard, but on Chris's, on your paper that it reflects some kind of panic that lenders' expectations are bad because prices look like where they looked in 1980, looking at data across cities, or not, historical levels, looking across cities, or on a reasonable growth trend on the coasts. The thing is, if you look at a place like San Francisco, you've got two submarkets. You've got the city, which is down maybe 10% off of its high, or even around here, you're off maybe 10%. And then you've got outlying areas, which are off 50%. And, should you be, you're going to be nervous about lending if you think there's any chance of a 20% reduction in price, obviously, if you're lending at something like 80% loan to values. And, why we shouldn't be scared about San Francisco falling another 20% isn't clear to me, given how much uncertainty we have in our valuation of dividends. And then in the periphery, I agree price equals replacement cost generally makes sense, but then that's the whole puzzle of how we got $500,000 prices for homes that cost $200,000 to build. You have to think, if in markets where you're close to replacement cost all the time, you've got an infinite elasticity, but that would tell you should have infinity houses in Vegas, Phoenix, and Fresno, and we don't have that, but we have close. So, it's not implausible that prices would fall well below replacement cost in the next couple of years. So that, I don't know that the pictures you showed us that we shouldn't be afraid of large price decreases and losses if the government intervenes and goes below market on pricing.
Another question? Yes. Okay, thank you.
I was very happy to hear somebody just mention the cost of time involved and the deterioration of houses that are left vacant, which I have no way of knowing if we have any systematic data on it, but particularly given the locales in Florida in particular, you're going to see very significant deterioration very quickly, and that's a real loss. It's not a financial loss. And so the bubble is not just a bubble, it's the consequence of the explosion is going to, or the explosion of the bubble is going to be to actually literally reduce the real value of the properties. And I don't know if I haven't heard this very much in the policy conversation, and maybe I'm exaggerating it. Maybe it's not such a large piece of the overall value of the inventory that's in question here. I don't know if anybody has comment.
I mean, one thing also to keep in mind is the property deteriorates a lot before the foreclosure actually occurs. So, I mean, all of the delays in the foreclosure process, that the moratoriums and things like that, that also is going to have an effect on the quality of the property. I mean, the one thing is, we keep talking about how the incentives are misaligned. I think the incentives are all perfectly aligned. I mean, not all perfectly aligned. I'm exaggerating a little here, but there's nothing intrinsic about this process. It's just like any other business. Some of the incentives aren't perfectly aligned, but I mean, in this case, for example, on the issue of getting rid of foreclosures, the servicer, everybody wants to they have an incentive to maximize the value of the property. And if the property is going to deteriorate, that's going to mean they're going to want to sell it quickly. So I don't think there's anything inherently reason why the servicer would not want to sell a property quickly. And they don't, one of the things, the lenders, they do not want to be in the real estate business. They want to get rid of this stuff. They have no desire to be in the real estate business. So I think they do want to get rid of the property. And as I said, I think the evidence we have in Massachusetts suggests that they, you know, after a slow start, they were figuring out how to unload this property. And I think one of the issues was that there was some initially some resistance to taking big losses. I mean, they somehow, you know, the property was, I mean, you hear these stories anecdotally, you know, of the property that was worth $100,000, you know, that the mortgage was $100,000 and someone came along and offered $70,000 and the lender laughed and hung up the phone on the buyer and then called him back a week later and said, is that offer still on the table? So I think that part of the process, I mean, it works as well as we could hope. I don't think there's any intrinsic problem there.
I completely disagree with that. And I do have some empirical evidence. I have actually written the only paper that I know of that looks at, actually looks at data about how foreclosures operate. It's in commercial real estate, not housing. But the data suggests very significant differences in how special servicers operate, the same special servicers. So you're looking at, you know, including fixed effects for the name themselves, depending on whether they have the first loss position or not in a deal. And I think that's kind of widely known in the industry, that people manage their own portfolios and their serviced portfolios quite differently in all sorts of ways. And I think it's hard to imagine, in fact, I think Bob may well be right, which is there would probably be more foreclosures if people were if they were servicing more, if they were servicing their serviced loans the way they service their own portfolio, precisely because of your point that they don't want to be known as the bank who gives away lots of cash. So, and the evidence in my paper shows exactly the same thing, which is when you're servicing your own portfolio, servicers move very quickly, and when they're servicing somebody else's portfolio, they move very slowly. And I think that's what we're seeing, and you could easily make the case that they're not moving quickly enough from maximizing the value of the portfolio perspective.
Chip?
Yeah, there's a group at Freddie Mac that's been collecting data for 2 years on that deterioration. They have very good data. I'll give you their names. And
one last question.
Bob and I did something a decade ago that suggested about a 47% deterioration of the value from the foreclosure dates of the sales date. Huge numbers. I mean, just more.
We have time for one last question.
That is internalized by lenders, though.
Thank you, gentlemen.
I thank you for what I've learned this afternoon, but my concern is I want to know what my equity in Freddie Mac and Fannie Mae. I want to find out my equity in AIG, and I also want to find out whether or not the lending freeze by the servicers. You know, I don't have a loan on my house. It's paid for. I would like to have a cash out refi, but how are they going to freeze? Are they going to be lending a little bit easily? Are they too strict? These are some of my concerns.
This isn't the right panel. I certainly I share your concerns, but I don't know anything. I don't think any of us do. Do you, Chris?
I think on that happy note, I want to thank the authors and the panel and the audience.